Chapter 2: The Accounting Cycle for the Service Business Accrual Basis. Welcome to Chapter 2 of Principles of Financial Accounting. In this chapter, we will explore the accounting cycle for a service business that uses the accrual basis of accounting. While Chapter 1 focused on the cash basis system, this chapter introduces the accrual method, the foundation for most modern accounting systems. Under the accrual basis, revenues are recorded when they are earned, not necessarily when cash is received. Likewise, expenses are recorded when they are incurred, not when cash is paid. This approach provides a more accurate picture of a company's financial performance and position within a specific period. Accounting on the accrual basis allows businesses to match their revenues with the expenses that help generate them. This concept, known as the matching principle, ensures that financial statements reflect the true results of operations for the period being reported. In this chapter, we will discuss how to record adjusting entries, explain the differences between accrued and deferred revenues and expenses, prepare an adjusted trial balance, and show how financial statements are completed under the accrual basis. Section 2.1: Understanding the accrual basis of accounting. Under the cash basis system, transactions are only recognized when cash changes hands. For instance, if a service is provided in one month but the customer pays the next month, the revenue is recorded only when the payment is received. While this method is simple, it can distort the real performance of the business because revenues and expenses may not match the period in which they actually occur. The accrual basis corrects this issue. It records revenues when they are earned and expenses when they are incurred, regardless of when the cash is received or paid. This provides a more consistent and realistic view of financial performance. For example, when a business performs a service on account, it records a revenue immediately even though the cash will be collected later. Similarly, when an expense such as rent or salaries is owed but not yet paid, it is recorded as an expense in the period it is incurred. By using the accrual method, a company's financial reports show not only the results of cash transactions but also the economic events that affect the business. Section 2.2: Adjusting entries. At the end of each accounting period, some revenues and expenses may have been earned or incurred but not yet recorded. Adjusting entries are made to bring the accounts up to date before preparing financial statements. These entries ensure that revenues are recognized in the period they are earned, and expenses are recognized in the period they are incurred. In accordance with the matching principle, there are two main categories of adjusting entries: accruals and deferrals. Accruals involve recording revenues or expenses that have been earned or incurred but not yet entered in the accounts. Deferrals, on the other hand, involve postponing the recognition of revenues or expenses that have already been recorded in cash but relate to future periods. Adjusting entries typically affect one income statement account and one balance sheet account. Without these adjustments, financial statements would not accurately reflect a business's true performance or financial position. The process of making adjusting entries follows a consistent pattern. First, the accountant identifies transactions that require adjustment. Then, the correct amount of revenue or expense to be recognized is determined. Finally, the adjusting entry is recorded in the general journal and posted to the ledger. Once all adjustments are complete, the company prepares an adjusted trial balance to verify that total debits equal total credits before preparing the financial statements. Section 2.3: Accrued revenues and accrued expenses. Accrued revenues are revenues that have been earned but not yet recorded in the accounts, usually because the related cash has not been received. For example, a consulting firm may complete services for a client in December but issue the invoice in January. Under the accrual basis, the firm records the revenue in December because that is when the service was performed. To record an accrued revenue, the accountant increases an asset account such as accounts receivable and increases a revenue account such as service revenue. This recognizes the income earned and establishes the customer's obligation to pay. Accrued expenses are the opposite. They are expenses that have been incurred but not yet recorded, typically because the bill or payment is pending. Examples include unpaid wages, interest, or utilities. To record an accrued expense, the accountant increases an expense account such as salarances expense and increases a liability account such as salaries payable. This ensures that the cost is recognized in the correct period even though cash will be paid later. By including accrued revenues and accrued expenses through adjusting entries, the company ensures its financial statements portray all activities that truly occurred during the period. Section 2.4: Deferred revenues and deferred expenses. Deferred revenues, sometimes called unearned revenues, arise when a business receives payment before providing goods or services. In this case, cash has been collected, but the company has not yet earned the revenue. Until the service or product is delivered, The payment represents a liability, an obligation to the customer. For example, if the company receives advance payment for a service to be performed in the next accounting period, it records the amount as unearned revenue, a liability account. As the service is performed, the liability decreases, and revenue is recognized accordingly. Deferred expenses, also known as prepaid expenses, occur when a business pays cash in advance for goods or services it will use in future periods. Common examples include prepaid rent, prepaid insurance, or supplies on hand. Initially, these payments are recorded as assets because they represent future economic benefits. As time passes and the benefit is used, the prepaid amount becomes an expense. For example, when insurance coverage is consumed each month, an adjusting entry transfers a portion of the prepaid insurance from the asset account to the insurance expense account. Section 2.5 The adjusted trial balance. Once all adjustments for accruals and deferrals are made, the company prepares an adjusted trial balance. This document lists all account titles and their updated balances after adjustments. It is used to verify that total debits still equal total credits, confirming that the books are balanced and ready for the preparation of financial statements. Section 2.6 Financial statements on the accrual basis. Once the adjusted trial balance has been completed and verified, the next step in the accounting cycle is to prepare the financial statements. These statements summarize all of the company's financial activities and present them in a clear, structured format for decision making. There are three main financial statements prepared in this step: the income statement, the statement of retained earnings, and the balance sheet. The income statement shows the company's revenues and expenses for a specific period and calculates the resulting net income or net loss. Under the accrual basis, revenue is recognized when it is earned, and expenses are recognized when they are incurred. The statement of retained earnings shows how the company's retained earnings have changed during the accounting period. It begins with the opening retained earnings balance, adds the period's net income, and subtracts any dividends declared. The result is the ending retained earnings, which is carried forward to the balance sheet. The balance sheet presents the company's financial position at a specific date. It lists assets, liabilities, and stockholders' equity. The accounting equation, assets equal liabilities plus stockholders' equity, must always remain in balance. Section 2.7 The closing process. After financial statements are prepared, temporary accounts, such as revenues, expenses, and dividends, must be reset to zero to prepare for the next accounting period. This is done through closing entries. The closing process ensures that the income and expense accounts only report activity for one period. It also updates the retained earnings account to include the net income or net loss from the period just ended. Section 2.8 The post-closing trial balance. After all closing entries have been journalized and posted, the company prepares a post-closing trial balance. The purpose of this step is to confirm that all temporary accounts have been properly closed and that the ledger is in balance before the new accounting period begins. By following the full accounting cycle, from journalizing and posting transactions to preparing adjusting entries, financial statements, and closing entries, the business ensures that its financial records are complete, accurate, and ready for decision making.